What if I told you that despite working harder than any generation before them, Millennials and Gen Z have somehow managed to become the poorest young adults in modern history? Not because they're lazy or spending all their money on avocado toast, but because the economic game has been rigged against them from day one. My name is Nick, and today we're diving deep into why an entire generation is getting financially destroyed, and it has absolutely nothing to do with their work ethic. Before we get started, make sure to hit that subscribe button because we're about to uncover some statistics that will completely change how you think about generational wealth. And trust me, by the end of this video, you'll understand exactly why your parents' advice about money might be completely useless in today's economy. Here's something that will blow your mind. Young people today have 86% less purchasing power than baby boomers had when they were in their 20s. 86%. That's not a typo. That means if a boomer could buy something for $1 back in their day, millennials and Gen Z would need almost $7 to buy the same thing today when you adjust for wages and costs. Now, I know what you're thinking. Like, every generation complains about how tough they have it, right? Your grandparents walked uphill both ways to school in the snow. Your parents had to use rotary phones, and now young people are crying about expensive coffee. But here's the difference. This time, the math actually backs up the complaints, and the numbers are absolutely devastating. Let's start with the biggest financial decision most people will ever make in their lives: buying a house. This is where things get really interesting, and by interesting, I mean completely insane. When the average baby boomer turned 33 years old back in 1988, they were living in a world where the median home price was $110,000. Their median household income was around $22,700 per year. Now, here's where we need to talk about something called the home price to income ratio. This is basically how many years of your entire salary it would take to buy a house outright. For boomers in 1988, that ratio was 4-1. Meaning if they somehow managed to save every single penny they earned for 4 years, they could buy the median home with cash. Some high earners could literally pay off their entire house with just 1 or 2 years of wages. Can you imagine that level of financial freedom? Fast forward to 2022 when the average millennial hit that same age of 33. The median home price had skyrocketed to $433,000, while the median household income was around $70,000. That puts the home price to income ratio at over 6-1. But wait, it gets worse, much worse. Historically, financial experts considered a home price to income ratio of 5 to be healthy and sustainable. I guess during the infamous housing bubble of 2006 to 2008, that ratio ballooned to 7. And we all know how that ended. Well, guess what? We're now consistently above those bubble levels, and nobody seems to be talking about it. It's like we're all pretending the house isn't on fire while we're sitting inside it drinking coffee. But here's where it gets really depressing. If you thought the United States was bad, let me tell you about our friends across the pond in the United Kingdom. They've been dealing with ratios consistently over 7 for the past decade, and lately they've been hovering around 9. So if you're British and watching this, I'm genuinely sorry. You're somehow more financially screwed than Americans, and that's saying something. At least you have free healthcare and good tea, though. The really fascinating part is when you look at the long-term trends. From 1955 to about 2005, household income generally kept pace with or even outpaced home prices. That was the golden era when people could actually afford to buy houses without selling their firstborn children. But something changed dramatically after 2005. Home prices started climbing faster than income, and they haven't looked back since. When you adjust for inflation, the numbers become even more ridiculous. According to data from the Bureau of Labor Statistics, spending $100,000 on a home in 1990 would be equivalent to spending about $377,000 today. But here's the kicker. For everyday goods and services, that same $100,000 from 1990 would only require about $231,000 today to buy the same amount of stuff. Do you see what's happening here? Home prices aren't just outpacing wages, they're outpacing inflation itself by a massive margin. It's like houses decided to run a marathon while everything else was taking a leisurely stroll through the park. Now, you might be wondering why this is happening. Is it some grand conspiracy by the housing industry? Are millennials just terrible at house hunting? The truth is actually more complex and involves several demographic and economic factors that created a perfect storm of unaffordability. First, let's talk about competition. And baby boomers didn't face nearly as much competition when they were house hunting back in the 70s and 80s. There simply weren't as many people living in the United States at that time. Population growth has exploded over the past few decades, which means way more buyers competing for roughly the same amount of housing stock. It's basic supply and demand, except the demand side went absolutely crazy while supply stayed relatively stagnant. Boomers also had another massive advantage that most people don't talk about. They were more likely to get married early and stay married, which meant they were combining two incomes from a much younger age. When you're 25 and married with dual incomes, buying a house becomes significantly more achievable than when you're 28, single, and trying to do it all on your own salary. This brings us to another fascinating shift in social patterns. According to research from the Pew Research Center, more than 4 out of 10 millennials don't live with a family of their own. That's about 45% compared to only 31% for previous generations. The silent generation, those born before the boomers, had only 15% living without their own families. Millennials are staying single longer, getting married later, and having fewer children. While this might be great for personal freedom and career development, it's absolutely terrible for home affordability. But wait, there's more. And by more, I mean student loans, which deserve their own category of financial devastation. This is where the generational wealth gap becomes truly obscene. The average cost of tuition at four-year institutions now ranges from $30,000 to $50,000 per year. Let that sink in for a moment. Baby boomers could often work part-time jobs during college and graduate with little to no debt. Many could even pay for their entire education with summer jobs. Today's students are looking at debt loads that would make a small country nervous. Student debt has ballooned into a $1.7 trillion crisis. Over the 30 years between 1991 and 2021, average tuition prices more than doubled, while the average loan balance at graduation tripled from around $10,000 to about $30,000. And here's the really scary part. About 7% of student loan borrowers now owe more than $100,000. That's mortgage-level debt for something you can't sell, can't return, and in most cases can't discharge in bankruptcy. The cruel irony is that college degrees are simultaneously becoming more expensive and less valuable. The number of college graduates has increased by 250% since 1970, which means there's significantly more competition for entry-level positions. Jobs that used to be truly entry-level now require experience, creating this impossible catch-22 where you need experience to get experience. Meanwhile, starting salaries have barely budged when adjusted for inflation. The average starting salary for a decent job hovers between $50,000 and $60,000 per year, and many graduates struggle to even reach that level. So you've got massive debt, stagnant wages, and inflated housing costs. It's like playing a video game where the difficulty level keeps increasing, but your character's stats stay the same. This economic pressure cooker extends beyond just housing and education. Let's talk about transportation costs, because even getting around has become a financial nightmare for younger generations. The average car payment today is over $700 per month, with loan terms stretching to nearly 6 years. 6 years. That's longer than most people keep their phones, and yet we're financing vehicles for longer than some presidential terms. When baby boomers were buying their first cars, they could often pay cash or take out short-term loans that didn't feel like a second mortgage. But here's where it gets really fun. gas prices have millennials and Gen Z paying 40 to 60% more than boomers did in their 20s when you adjust for wages. So not only are you paying more for the car, you're paying significantly more to put gas in it. It's like the entire transportation system looked at young people and said, you know what, let's make this as expensive as possible. And don't even get me started on car insurance. Young drivers are paying premium rates that would make a hedge fund manager weep. The average young adult is looking at insurance costs that can easily run $200 to $300 per month, especially if you live in a major city. That's nearly $4,000 per year just for the privilege of legally driving a car you're already paying $700 per month to own. Credit card debt and consumer loans have reached all-time highs, creating a financial death spiral for millions of young adults. When your housing costs are sky high, your student loans are crushing you, and your transportation costs are through the roof, what do you do when unexpected expenses pop up? You put them on credit cards, of course, and with interest rates on credit cards now hovering around 20 to 25%, that emergency dental bill or car repair becomes a long-term financial disaster. The really maddening part is that older generations often look at these statistics and blame young people for their financial struggles. They'll point to expensive coffee drinks, subscription services, or dining out as the reason millennials and Gen Z can't afford houses. But let's do some quick math here. Even if you eliminated every single discretionary purchase a young person makes, even if they lived like monks and never bought anything fun ever, they still couldn't make up for the massive increase in housing, education, and transportation costs. You could skip every latte for a decade and still not have enough for a down payment in most major cities. The math simply doesn't work. It's like trying to bail out the Titanic with a coffee cup. Sure, you're technically removing water, but you're not even close to solving the actual problem. Social media has made this situation even more psychologically damaging. Young people are constantly bombarded with images of their peers seemingly living lavish lifestyles, buying homes, taking expensive vacations, and driving new cars. What they don't see are the credit card statements, the family money, or the crushing debt behind those Instagram posts. This creates a toxic cycle where people feel pressured to spend money they don't have to maintain an image they can't afford. The gig economy, which was supposed to provide flexibility and additional income opportunities, has instead become a necessity for survival. Millions of young adults are driving for ride-sharing companies, delivering food, or picking up freelance work just to make ends meet. What previous generations did for extra spending money, current generations are doing to pay rent. The side hustle isn't supplemental income anymore. It's often the difference between financial survival and complete disaster. But here's something that really drives me crazy about this whole situation. Despite all these financial headwinds, despite the fact that the economic deck is completely stacked against them, millennials and Gen Z are still being told they're lazy or entitled. They're working multiple jobs, dealing with unprecedented levels of economic stress, and somehow they're the problem. It's like blaming someone for drowning while you're standing on their head, pushing them underwater. The retirement situation is perhaps the most terrifying aspect of this generational wealth crisis. Social Security, which previous generations could count on as a reliable safety net, is projected to face significant funding challenges by the time current young adults reach retirement age. The traditional pension system that provided guaranteed income for retirees has largely disappeared, replaced by individual retirement accounts that shift all the investment risk onto workers themselves. Young adults today are being told they need to save more for retirement than any previous generation, while simultaneously dealing with higher costs for everything else. Financial experts recommend saving 15 to 20% of your income for retirement. But when housing costs alone are eating up 40 to 50% of someone's paycheck, that advice becomes mathematically impossible to follow. The healthcare system adds another layer of financial complexity that previous generations didn't face to the same degree. Young adults are dealing with higher healthcare costs, less comprehensive insurance coverage, and more out-of-pocket expenses. A single medical emergency can wipe out years of careful saving, creating a constant state of financial anxiety that affects every decision they make. Even starting a family has become a luxury that many young adults feel they can't afford. The cost of childcare in many areas now exceeds what previous generations paid for their entire mortgages. Raising a child from birth to age 18 is estimated to cost over $250,000, and that's before considering college expenses. Is it any wonder that birth rates are declining when having children has become financially prohibitive for so many people? The psychological toll of this financial stress cannot be overstated. Young adults are experiencing higher rates of anxiety and depression, much of which is directly linked to financial insecurity. They're delaying major life decisions, living with roommates well into their 30s, and putting off dreams because the basic necessities of life have become unaffordable luxuries. What makes this situation particularly frustrating is that many of these problems are solvable, but they require systemic changes rather than individual solutions. You can't budget your way out of a housing crisis. You can't side hustle your way out of stagnant wages. You can't meal prep your way out of healthcare costs that have tripled in the past decade. The technology sector, which was supposed to create new opportunities and level the playing field, has instead contributed to wealth concentration and geographic inequality. Tech jobs pay well, but they're concentrated in expensive cities where housing costs eat up most of the salary advantage. Meanwhile, traditional middle-class jobs in smaller cities have seen wages stagnate while costs have continued to rise. Looking at international comparisons makes the situation even more depressing. Young adults in countries with stronger social safety nets, subsidized education, and regulated housing markets are achieving traditional milestones of financial independence at much higher rates than their American counterparts. It's not that young people everywhere are struggling equally, it's that American young people are dealing with a uniquely dysfunctional economic system that prioritizes short-term profits over long-term societal stability. But here's what really gets me fired up about this whole situation. Instead of acknowledging these structural problems and working to fix them, we're having debates about whether young people deserve financial stability. We're arguing about whether they should be able to afford houses or start families or retire with dignity. These aren't luxury items we're talking about. These are the basic building blocks of a functioning society, and we've somehow made them unattainable for an entire generation. The solution isn't rocket science, but it requires people to actually acknowledge what's happening instead of pretending everything is fine. If you're a young adult watching this and feeling completely overwhelmed by these statistics, I want you to know that your frustration is completely justified. You're not crazy for thinking the system is rigged against you, because frankly, it is. But here's the thing that drives me absolutely insane about this whole mess. We keep getting told that the solution is individual responsibility, work harder, save more, make better choices. It's like telling someone to swim faster when you've tied concrete blocks to their ankles. Sure, technically they could try to swim harder, but maybe we should address the concrete blocks first. Despite all of this economic chaos, there are still some strategies that can help you navigate this financial wasteland. The key is understanding that the old rules don't apply anymore, so you need to play by a completely different set of guidelines. First, let's talk about housing, because this is where most people get completely destroyed financially. The traditional advice about spending 30% of your income on rent or mortgage payments, that's adorable, but it's based on an economy that no longer exists. In many markets, finding anything decent for 30% of your income is about as realistic as finding a unicorn that does your taxes. If you're trying to rent, you might need to push that percentage higher, but here's the crucial part. If you're spending 40 or 50% of your income on housing, every other expense needs to be scrutinized with the intensity of a forensic accountant. You can't have expensive car payments, you can't carry credit card debt, And you definitely can't be spending money on things you don't absolutely need. For those dreaming of homeownership, the math has changed so dramatically that you need to approach it like you're planning a military operation. That old advice about putting down 20%, forget it. Many successful first-time buyers today are putting down 3 to 5% and using first-time buyer programs that previous generations didn't need because houses actually used to be affordable. The automobile situation is where I see people make some of the most devastating financial mistakes. That $700 monthly car payment I mentioned earlier, that's not just a payment, that's a wealth destroyer. Over the life of a typical auto loan, you're looking at paying $50,000 to $60,000 for a car that will be worth maybe $15,000 when you finally finish paying for it. So there you have it. Millennials and Gen Z aren't broke because they're buying too much avocado toast or because they lack work ethic. They're financially struggling because they're trying to play a game where someone changed all the rules without telling them. Housing costs have exploded, education has become a luxury item, and basic transportation now requires a small loan. The American dream didn't die, it just became prohibitively expensive. If you found this eye-opening, make sure to subscribe and let me know in the comments what generational financial myth you'd like me to tackle next.